Welcome to the Ideal Investor Show. Join us on the journey to financial success. Let's go. Hello and welcome back to the Ideal Investor Show. And today we want to talk about something that I touched on a while ago. I think it's probably about a year ago by now. And the title of today's episode is Rate Cuts and Real Estate, What Investors Must Know. Now, if you want to go back in previous episodes, I have talked about the Federal Reserve and how they actually function and so forth. So I'm not going to regurgitate all of this. But one of the things that I find is interesting is the media. And I have to say, it's really getting harder and harder to actually pay attention to the media because most of what they publish is just basically negative news in the headlines that is supposed to act like clickbait and trigger you. But for those who still make an effort to give you reasonable information, when there is a change in interest rates by the Federal Reserve, a so-called rate cut, there's almost always reporting that makes it sound like that real estate will in some way be impacted. And what I want to tell you and what you must know about it is, what do rate cuts by the Federal Reserve really mean? And what is the impact on real estate? So the rates that the Federal Reserve is setting are rates for the exchange of money between that Federal Reserve organization and the banks. It's called short-term interest rates. So if a bank like Chase or Wells Fargo or so forth is going to borrow money from the Federal Reserve, basically from a quasi-government organization, it determines what is the interest rate that they have to pay for it. Now, this bank exchange rate also impacts the interest rate that the Treasury Department is using to determine how much interest are we paying on bonds. And those could be 2-year bonds and 5-year bonds and 10-year bonds and longer. But the one that is most impacted by these Federal Reserve rate cuts is the 10-year Treasury bond. So now if you think about it, what does all this mean? The interest rates that we are affected by for our mortgages are also related to the bonds. And a bond is issued with a certain starting interest rate. But one of the things that people sometimes forget, and we have heard this now in the last few months more and more in the media, is that anybody who is buying these bonds from the government will have to ask themselves, is the government going to pay us back as promised with interest? And the government in the United States right now has $36 trillion in debt, and this debt is all bonds basically, or pretty much all bonds. And the higher this number goes, the more the question is relevant, will I really get my money back? And if there is any doubt, how do you cater for this? It's basically a matter of risk. If you say, I'm not 100% sure if I get my money back, but if those who give me the bond pay more interest, I'm willing to take that risk. Right? So what does this mean? When the Federal Reserve is reducing the interest rate that banks have to pay when they borrow money, and there's a ratio between that amount and how much the interest rate is for the bonds, and the mortgage rates are also related to the bonds, then there is an impact to the mortgage rate, which is what we pay as real estate investors for our mortgages. What is also very relevant is that it's not a straight line. The more the government is getting into debt, the more they have to pay other people in interest to be willing to take that risk, to give their money, get the bond, and then hope that in 2, 3, 5, 7, 10, 15 years they get their money back plus interest. What we have seen in 2024 is, even though the Federal Reserve has lowered the rate, the interest rate for these bank transactions several times by about 1% total, the interest rate on the bonds has not really come down. And when you ask yourself, why is that? And which is also, by the way, the reason why the interest rate for mortgages has barely come down, is because they have been piling on so much additional debt that people are saying, if you want me to buy these bonds, you have to give me a higher interest rate. And that's what we're ultimately going to see. Now, it is still too early to say, are all these measures that the new administration in the United States are now taking, like lowering taxes and trying to get the economy moving and really reviewing all the different government agencies and all the books and all this kind of fraud and abuse and waste and so forth, is this actually going to successfully start the engine of the economy? Because if that happens, then people will have more faith in the ability of the government to pay back any kind of bond and any kind of interest and so forth, which will ultimately mean the rates will come down for everybody, including us as investors for our mortgages. But until we really see any evidence, and until we don't see that the debt is in a better ratio to the overall economy, it is a negative impact, and it means our mortgages will remain expensive when you look at the interest rates. And what it ultimately means for the market is also that the real estate market overall, even though there are millions of people who would like to get into their own house or into a bigger house, they currently can't really do anything because the mortgages are just too expensive. The good thing for us as investors is that we don't have a whole lot of competition, and the bad thing at the same time is that when we want to make a lot of positive cash flow from our investments, it's very hard to do when a lot of money needs to go into paying the mortgage interest rates. So I hope that gives you a little bit of an idea how rate cuts, when they happen on the Federal Reserve level, do or do not impact what we have to know as investors for our real estate investing. Only when the economy is doing well and the debt is no longer increasing like crazy will we see a positive impact of rate cuts to our mortgage interest rates. So that's the bottom line. Keep an eye out for that and don't fall for any clickbait by the media that just wants to give you some horror scenario. So that's it for today. Be well and stay safe, and I'll talk to you soon.